Hey folks, and welcome back to the channel. Today we're talking about the economic uncertainty with the markets, the market crashes, and why it doesn't matter, why you should not worry, at least for now, if you are a younger millennial, early 20s, just starting out with your savings journey. Now, before I get flamed for making this video and making all of these broad generalizations, I just want to put it out there that this video will be based on a lot of generalizations, a lot of median average statistics, a lot of assumptions that we're going to make. We're going to assume that the market will increase, things will grow and get better over the course of the next 30 to 40 years. Obviously, with any assumption, there is a chance that this will not be true. The market could go down, could stay flat. We don't know for sure. But by most accounts, I think we can safely assume that we'll see growth. And we're also not going to go too deep into other economic factors that could come out of a depression or a market crash related to job loss, unemployment, wages going down, losing benefits, all that stuff. The real world out there is complicated and it's complex, but we just don't have enough time in this short YouTube video to touch upon everything. So we're using generalized numbers, we're using the average numbers. This may not apply to you. You might be in a different situation given your income, your background, your history, where you live, all that stuff. As I said before, the market is uncertain. We had a crash back earlier this year. We've recovered. But why, as a younger millennial or someone who's in college, just graduated, working their first job, why does this not matter? Well, when we think about the market, we really think about your investments. So this would be any investment accounts, brokerage accounts you have open if you're investing in the stock market, bonds, index funds, or if you have a retirement account, Roth, 401k, any of that stuff. It's up to you to put money in to invest and to set yourself up for retirement, unlike something like a pension where you're guaranteed to have a certain amount of money after you've worked so many years. A little bit different. This one you have to actively manage yourself. So like I said, I assume we're in our mid to early 20s and the stock market's going up. Investing for retirement and for the long term's a little different than retail investing or just investing for the short term, a couple of years. If I'm just looking at the short term, if I buy Tesla stock today, 400, it goes up to 600, I'll sell it, I'll make a profit. Or if it goes down, maybe I might get scared, maybe I'll sell it and lose some money out of it. But I'm not really thinking about the long term. I'm thinking about if I can make some money right now, extra spending money, or if I just want to put the extra money into savings. But in the long term, I can just buy one share of Tesla stock right now, $400, go into a deep sleep, freeze my body, wake up in 40 years. Where is that stock going to be in 40 years? And this is just one share. I'm not buying one share a month. I'm not buying one share a week. We're just looking at one share, tracking this, and thinking about how the time horizon affects us differently. Assuming that they've grown $400 today, maybe it's $800 in 40 years. I've held on, I haven't sold. The stock could have dipped to 1 penny. Maybe Elon Musk had to attach rockets to cars or do some crazy instant charging technology to get the company back on track. It was down to a penny. We don't care about any of the prices from today until that one day before I woke up in the next 40 years. We're just concerned about when we wake up in 40 years, what's the price? What can I sell at? Use that money to fund my retirement. So this is key when we're thinking about this video. It's the long run. The short run, 5, 10, 20 years doesn't matter as much. And we'll get into the investing consistently and contributing and how that affects our retirement and investing goals. So right now, I'm going to go really quickly into some average stats that we'll use for the rest of this video. To start out, the average net worth of someone in their 20s right now is negative, believe it or not, about negative 30,000. And this is because most people have some type of student loans You know, the picture is pretty grim. If you have $1 in your savings account and no student loans or any debts, you're already better off than most people out there. We're going to move on and focus on the investment and the retirement savings. In order to try to think about how much we're saving for the future, we have to first think about how much we make right now. The average income for a college grad is around $51,000. This, once again, will vary based on your industry, your location, your prior experiences, and doesn't take into account any other perks you may have, stock options or things like that. And we also assume that the goal is to try to save 20% of our income. This, once again, will also change based on your circumstances. If you have to pay off student loans, or if you have other debts to pay off, or maybe you can save more. But we're going to go with the 20%, the goal that a lot of advisors will recommend. Before I get too deep into this, also, everything here will vary. So if you want more personalized numbers, plug those into calculators or reach out to your own financial advisor to see what's best for your unique situation. So right now we're earning about $50,000 a year and we're trying to save 20%. So 20% of $51,000 comes out to about $10,000 a year in savings. So that's the total amount we're trying to save. And looking at retirement specifically, the average company match for a 401k is about 4%. So they'll match 4% of your own contributions towards that. The rules vary company to company. You might have to have worked there for 1 year or 2 years, or you might have to contribute up to 6% and they'll give you half. The rules differ, but for the sake of this video, we're gonna assume that your company is offering you 4% match. So the company offers you 4%, we're gonna assume that you are contributing 5%. The average contribution is around 8%, so somewhere a little bit above the bare minimum to get the full match. 5% goes towards retirement. So if you max that out, 5% of your $51,000 a year, that comes out to about $2,550 going into your 401k or retirement accounts every single year. So out of that $10,000 in savings, $2,550 is going towards retirement, which means about $7,450 is going into general savings. And out of that, let's also assume you're a casual investor, you have Robinhood, some other stock brokerage app. Another 20% of that $7,000 is going towards that investment account, short-term investments, not your long-term retirement account. So about $1,500 is put into your investment account. So to break this down a bit, I rounded the numbers for simplicity. $10,000 in savings, 20% of your annual income. $2,550 of that is going towards your retirement 401k account. About $6,000 is pure savings going into a savings account, hopefully high interest savings, and another $1,500 is put into an investments account if you invest in stocks or index funds. So straight out of college, that's what our accounts are looking like after 1 year. And we come into this year, everything's looking good, it's going up and up and up. We reach March, market crash, we all know about it, 20% crash, terrible, everyone's scared, panicking. What do we do? Are we entering a recession, a depression? What's going on here? So let's say now you're pretty young, and based on 2019 and that incredible bull run that we had, you were feeling pretty good about yourself and you had some pretty aggressive investments. So although the markets in general, the indexes fell 20% or so, you actually lost 30% because the things that you were in were pretty risky and they took a hard hit. So now let's assume that at the end of the year, it's still that 30% loss. We're gonna ignore the gains that we've made since then. So what does your account look like now, 1 year later, after a terrible year, down 30%? And keep in mind, this is just the value of your investment account. So retirement and that investment brokerage account, these are things that are in the market. Your savings account, I'm assuming, is in just a normal savings account with a bank, high interest savings. You're getting 1%. You're actually gaining 1%. You're not losing any money on that. Your retirement account is now only at $1,800. We've lost 30%. Your savings actually grew by 1%, so you gained $100 to $6,100. And your investment account down to $1,000 now. We lost big on stocks. The total, we're at about $8,900. So we've lost a little over $1,000 from that initial $10,000 that we put aside just from the first year. This is absolute worst case scenario, a terrible year for us. We lost $1,000. So we're probably thinking now, $1,000, that's pretty bad, right? We've just got our first job. We've worked for a year, worked so hard to save. We lost $1,000. It's terrible. But most of that money in the savings account has actually grown a little. We haven't had to draw from that. We're building our short-term emergency fund or building money towards paying off debts or maybe buying a house down the road. But our retirement and investment accounts have been hit. But we look at here, $1,000 loss from the first year. But the thing is, we don't actually need this money. We're not going to touch most of this money, the retirement account, for the next 35 to 45 years. And on top of that, next year, the company match is going to kick in. We're going to get another 4% of whatever we put in absolutely free from the company. That money is ours to keep. And we're also putting in another $2,500. And hopefully, I'm really hoping that the market's not going to be down another 30% next year. Remember how we ignored all the gains that we had? Realistically speaking, you might even be ahead a little at this point in time, late September 2020. We don't know what the end of the year, we don't know what next year is going to look like, but realistically, you're probably ahead a little bit. So all of that fear, all of that panic that happened earlier this year just completely got wiped out. And that wasn't even the long run. That wasn't even a 10-year span. That was less than 6 months. We're back to where we were, maybe even ahead a little. And if you are skeptical, maybe yes, the next 3 to 5 years, we don't know what's going to happen. But considering what happened in just 6 months, things could go way south, yes. But I do really think 40 years from now, you're going to be fine. And this is why you shouldn't panic if you're young. First, you don't have that much money. So second, you can't lose that much money. Even if you lost everything you invested, that's $10,000 gone. It sucks, it hurts, it's not great, yes. But you still have 40 years to build it back up. And also, you wouldn't have lost 10 grand. You would have only lost about 4 grand from your investment accounts. Remember that savings is still yours. So it's not all doom and gloom. The people that really should be concerned are those who are closer to retirement. Let's look at another example. So let's say you're 60, you're a couple years away from retirement. The average retirement savings account for someone in their 60s is about $182,000. And also assuming that they've been crazy aggressive these past years, they took a 30% loss. That's going to bring them down to $127,000. That's a pretty big loss, especially when you're expecting to need and to use that money in just a couple years. But also, let's say they weren't actually that crazy. They diversified a little. They were more conservative, knowing that they didn't want to risk a big loss going into retirement. They only lost 5%. So 5% from 182 is $172,000. So even a 5% loss is still $10,000 for them. And that $10,000 is all of your savings that you put in as a fresh college student. That's all the money that you saved up for 1 year just lost from 5%. So now we can see that yes, this is concerning now for not only if you have 182,000, but imagine if you had $3 million in that account and you lost 5% or you lost 20%. That is the time to panic. How am I going to get that money back? I need it in just a couple years. Good thing the markets did recover a little, but there's still a ton of uncertainty. So looking at that number further, 182,000 seems pretty low when most people will try to have at least a couple $1 million in retirement based on your lifestyle, your goals, and your expenses. But keep in mind that most people who are 60 right now can probably rely on Social Security checks coming to them during retirement. The same thing may not apply when millennials get to retirement age. And also, a lot of people now have pensions from back in the day that carried over that they can rely on when they retire. So there might not be as big of a need to have a 401k built up. They have other sources of income that they're able to draw on reliably. Once again, this picture will be completely different when the millennials go towards retirement age. I'm expecting those 401k accounts to be a lot higher because we have to manage those balances ourselves. Pensions are becoming less and less common. Social Security is up in the air. Who knows how that program is going to pan out in the next 40 years. So there's a lot of uncertainty, but You can really control your future. We look into the examples to what happens when we're thinking about that long time horizon. Looking at the next 40 years for a millennial that's just started out. So right now, your retirement account looks pretty shot. You lost $1,000 in the first year. You're not making that much to begin with. But if you continue to put in 5% into that retirement account year over year, and we're assuming that match kicks in next year, so you're going to be getting double the amount of money that you put in this year, effectively 10% going into your retirement where you're only putting in 5%. So even if the market goes down a little bit, that match will come in and you'll still come out on top as long as we don't see any crazy market drops. So if we assume you have $1,800 in your retirement account this year, and next year you will have $5,000 contributed, the $2,500 plus that match, which is a little lower, but we're going to round up to $5,000. You keep on investing just like that every year for the next 40 years, 5% return from the markets year over year. You're going to have about $620,000 in your retirement account in 40 years. And this is also, keep in mind, an extremely conservative estimate. We're not even factoring that your pay will probably be more than what you have now. The 5% contribution rate's based on a $50,000 a year salary. Assuming you don't have that same salary for the next 40 years, it might grow. By the end of it, you might be making $200,000 a year. Imagine contributing 5% of $200,000 in the later years. And later on, you might be better off. You might be able to put in 10%. The returns that we're seeing might be 5, 6, 7, 8%. We might have a great period of time. You can mess around with the numbers, but this is still a very conservative estimate. My take is that we really shouldn't panic if you're young and if you plan on investing consistently. The next couple of years might be uncertain. There will probably be other economic effects. The job market's not really good. If you're not able to find a job, this will set you back a couple of years. You won't be able to save up. You might have debt building up. So granted, those are still valid concerns. But for the average person, the crash right now, just look at it as that. A short-term thing. Your Robinhood account might take a hit, but your savings account, your retirement account is all probably going to be fine. I'm being optimistic here in the long run. It's very abstract to think about the next 40 years or so, but if you just have automatic deductions or reoccurring investments, set that aside. Don't look at it. There's a ton of automated investing managers. You can pay a small fee to have someone manage that money for you. And also, if you are starting out right now, you don't have that much money invested, could consider paying for those managed services because they usually take a percentage of the money that you invest. So if I only have $2,000 invested, a 0.05% fee is not that much. Whereas later on, have a couple $1,000,000 in there, yeah, 0.05 might be a decent chunk of money. But right now, use those services available to you. Talk to a financial advisor, figure out a plan, how much you're willing to save, how much you're able to save right now, and do that every single year, year over year. Don't look at it. Maybe be a little bit more conservative right now if that's going to help you sleep better at night, to just know that another crash might come, but you won't be as invested into stocks, or you might want to put more money into bonds or things like that. But at the end of the day, if you have a retirement account, if you have a company match, you're already ahead of the curve. Most millennials right now don't even have an investment account, and 30% don't even have a retirement account. So just by watching this video, you're already ahead of the game. You're already going to be thousands of dollars ahead of those that aren't able to save right now or haven't started saving right now. So take this time to evaluate yourself. Tons of resources out there, calculations, investment calculators. You can spend all day putting in the numbers, estimating your income, estimating your returns, all that good stuff. But just don't panic. Right now, I think we should be okay. Obviously, once again, we don't know exactly how things are going to pan out. But if history has anything to say, an investment now will pay off in the future. So be smart with your money, invest it where you can. And like this video, if you thought this was useful, gave you some things to think about, would really appreciate the support. Comment down below if you have any other suggestions, any other comments, or your thoughts on retirement investing, what you think is going to happen in the market. And as always, stay subscribed. Hit that subscribe button if you haven't done so already. That's all I have for you today. Thanks for watching.